Step into the metalverse, a vast, ever-evolving realm where industrial metals take shape amidst shifting prices, market trends, and supply chain forces. But what does it all mean for you? Welcome to Cup of Joe. Named in honor of our founder, Joseph T. Ryerson, we help you navigate the metalverse, one conversation at a time.
It's big, it's beautiful. It's the July Cup of Joe. And thanks everybody for joining in this month. And Nick, I think big beautiful is a big thing right now, but I think our show's been that well before it's been in the news. What do you think?
Absolutely. Are you down with OBBB?
OBBB? Oh, big
The
beautiful
one big
bill.
beautiful bill.
I like it. Yeah.
Yeah, you know me.
That should have been my response. Yes, I'm
It's
off.
okay. It's okay.
I'm off.
This is live. This is live.
Yeah. Gosh. Oof. Well, I'm already checked out for the weekend, so I apologize. How are you, Nick?
I'm doing very well, and happy to be here for anybody who's tuned in. You know, you're obviously one of the hardcores because I think we're probably the ones standing in the way between yourself and your holiday festivities. So hopefully we've got some great content for everybody, and everybody enjoys it. But I'm already enjoying your background right there. It's beautiful.
Yeah, thank you. It is. It's big and beautiful, and yeah, it's hopefully we'll be seeing some fireworks later on. But yeah, we the show goes on, holiday or not, and I think we got some good stuff to talk about today. Seeing that we're recording this on July 3rd, tomorrow's July 4th. A few days ago was Canada Day. So we're going to have some stuff about kind of an ode to manufacturing. And I think you've cooked up some good stuff about how to tie in metal facts to the holiday later on, which I think will be a really fun discussion. But of course, we're going to get into everything like we always do, metal prices, what's going on the macro side, and maybe even talk a little bit about the 4th of July. So Nick, what do you got for us today?
Yeah, let's go ahead and do it. Before we do, as always, we have to hop through our safe harbor provision. These are the opinions of Nick Webb and Mike Carrozzo. Do your own research, but we got some great content in here. Got a lot of new charts within this slide deck, and some fun content within here as well. We're gonna have a little bit of fun with it, given the fact that we're in the thick of the holidays here this summer. But first things first, I'm actually going to kick it back over to you, Mike, to give us a little bit of an ode to manufacturing, North American manufacturing, and then I'm going to piggyback on the back of that with a couple of pieces of my own. So go ahead and take away your bit if you'd like.
Yeah, so we thought, as I mentioned, right, we're recording this on the 3rd. Tomorrow's the 4th of July. Canada Day was a few days ago, and then we don't want to leave out Mexico. But this is kind of a tee up for August's Cup of Joe. We're going to have a general manager from Ryerson in Mexico, talk a little bit about the economy and manufacturing out there. So I think that's going to be a really interesting discussion. So Nick and I were talking, it might be great to kind of do a little ode to manufacturing, because really that's the audience, right? That's who we're talking about, and this industry is really tremendous, and it's something that our CEO Eddie Lehner is really passionate about, and American manufacturing and a lot of things that, I mean, you see the facts all the time, but I think it just, you get very patriotic around this time of year. At least I do, right? And you start to look back and you think, okay, here's all the things that are really good about this industry that, Ryerson is a key in the supply chain for, but we're all kind of working together, right? So we put together this little graphic here, and the one that always gets me is that one there on the would be bright side of my screen, bottom right. So if manufacturing in the United States was a country, it would be the 8th in world economic rank. I mean, that's huge, right? I mean, that's a lot of output.
Yep.
And and when you go over to Canada, you've got 10% of the economic activity and the jobs are coming from the manufacturing industry. And you'll see there down the middle, we kind of tried to estimate how many manufacturing firms are currently in these 3 countries, 90,000 plus in Canada, over 600,000 in the United States, and 5,200 in Mexico. And I think what really stands out is, I mean, it's a pretty large exporter in the world. I should say world and not largest exporter in the word, but you get what we're getting at. But yeah, I mean, just, hey, just a time of year to really think about, everything that's great about, this country and the, North America in general. And I think manufacturing is a big part of that.
Yeah, and I think it also stems into a lot of what we've been talking about for the last several months and what we're probably going to be talking about for the next next several months, which is the USMCA. And as it relates to tariff talk, we're already seeing some developments within that space. And it really is kind of USMCA centric. So what you're seeing on the screen really is the entirety of the manufacturing area that I would say the U.S. and the current administration is really trying to protect. And this isn't to say, we're trying to prop up the current administration or anything, but it certainly seems like a very valid goal that they're working towards at the moment. And with that, I guess I'll take it from there and just quickly transition into, this is a slide that we've used, I think, for the last 3, maybe even 4 Cup of Joes. And it's really just to act as a placeholder, because several months ago, Secretary of Treasury Scott Bessent said that basically take about 17 countries who we have our largest trade deficits with, knock off China, you've got another 16 or so, and those are the ones that we're going to rapidly try and get trade deals with. And I had highlighted Japan, South Korea, and India. I think maybe even Scott Bessent was the reason why I highlighted that, in saying that those should be the ones that we knock off first. Well, fast forward 2 or 3 months later to where we are today, and those 3 in the green are still not really addressed. I'll quickly highlight Japan. Actually, in the last week or so, Trump has actually come forward and said that, and it's kind of funny almost, that he said that Japan doesn't have any interest in buying U.S. rice. So for that reason, he's currently wanting to put 35% tariffs on Japan. So that discussion is actually not going so well. We do have some updates with regards to Canada, some updates with regards to Mexico. And then just in the last 24 hours, we got what looks like a pretty substantive bit of detail around Vietnam. And I'll highlight some of that here on this page. On the left-hand side, obviously, you've got Trump's Truth Social post. I'm not going to read it word for word, but in essence, what it's saying is for any goods coming out of Vietnam into the United States, the current expectation is that they're going to get hit with 20% tariffs. And for those keeping score, in comparing that to Liberation Day tariffs were right around 46% for Vietnam. So it is a pretty substantial drop in the broad-based tariffs coming straight out of Vietnam. Worth noting, it was also mentioned that for any product that is transshipped, it's going to have a 40% tariff on any products being transshipped. Now, what is transshipping? Technically, transshipping is just the movement of taking one good, putting it on another vessel, and then moving it on to another place. In the spirit of manufacturing and commodities and metals, it would be the idea of something like Vietnam importing Chinese steel, let's say, not doing much substantial transformation to it. So we're not really doing any additive, manufacturing processes to it, simply just repackaging it, putting it on a vessel, and sending it to the United States. That would be an example of transshipping. And so why is that important? I think I talked about this maybe 2 months ago, but whether it's Canada, Mexico, or any one of our other trade partners we're trying to negotiate trade deals with, I made the illusion or the assumption that it seemed like the main culprit, and maybe it's no big secret, the main culprit is China. They're really the one that I think are being targeted in all of this. So via all of these trade negotiations, it seems as though somewhere in the background, China is a big elephant in the room that's being discussed. And the reason why I bring that up is you look at the right-hand side, this chart here, basically it's showing in the red line, Chinese exports direct into the United States. The blue line is showing Vietnamese exports into the United States. You can see that starting about 2021, the Chinese exports into the U.S. direct really kind of tapered off. They flattened out and have even come down a little bit. But the Vietnamese exports have continued to go somewhat parabolic and jump pretty substantively over that time period. The suggestion within this chart is that some of that could be transshipped material. So that would be things coming out of China, going through Vietnam, getting a smaller tariff rate or no tariff rate, and then coming to the United States. So it's just one more, stepping stone en route to the United States, but it's still ultimately Chinese goods that may or may not be dumped, subsidized, things like that. So again, I think this is what that 40% is really trying to address. It's this idea that any gamesmanship within trade really kind of needs to be addressed. We're not seeing it just within Vietnam. Canada in the last couple of weeks has suggested they're looking at doing a tariff rate quota basically a quota on their own steel imports from other nations. So kind of trying to put a cap on the allowance of foreign nations selling steel into their country. And I think, again, that's primarily trying to address China. And then similarly, even Mexico is starting to look like it's evolving to something similar, which is they're talking about tariff rate quotas on their own steel industry coming to the United States. But I think at the end of the day, all of these agreements have some hint that this is all centered around China and trying to keep Chinese goods from moving around the world and ultimately landing back here in the United States.
So I'm going to summarize that back, right? So Chinese steel goes through Vietnam, gets sold to us through Vietnam, it would be a 40% tariff, right? So they're trying to protect that, right? So if I tie this back to our customers or the steel industry in general, this is where something like at its minimum, a mill test report would absolutely be the right thing, right? Because the origin of the steel, right? If you can't be using that, but I think it wouldn't even make it that far, right? Because coming in, it would already be hit by that 40% tariff.
That's right. And I mean, I will admit, I'm making some assumptions in this because we don't have the full details of what's going to be, landed on from a final trade deal with Vietnam.
Mm-hmm.
But that's the early take. There's still question marks about if let's say hot rolled coil comes into Vietnam, they turn it into cold rolled coil. Is that enough of a substantial transformation to then call it Vietnamese steel? We don't know how that relates to the terms of this trade deal. Normal trade would say that substantial transformation does change its country of origin, but we'll have to wait and see on those details. But the essence of what we're looking at is really kind of shown here within this chart, I would say.
Yeah.
Now, flipping over to, I didn't know whether I was going to put this in the macro side of things or more around this trade discussion, but I think the trade discussion makes a lot of sense. Interestingly enough, and you can see that basically since January of 2025, so in essence, when President Trump got into office, we have seen the worst performance of the US dollar since 1973. So what would that be? About 50 or so years. And we've moved, and this is the DXY index. So this is looking at the US dollar compared to a basket of other currencies. What does that mean for anybody here on this call? Well, if you're planning a trip to Europe or to really most other nations, a weaker dollar is kind of a bad thing. It means that your money's not going to go quite as far, your US dollar is not going to go quite as far when you travel to Europe or someplace abroad. But what it does do, and this is perhaps part of the plan, and I don't want to give too much credit to the administration, but what a weaker currency here within the United States does is it does benefit U.S. exports. For other countries, it makes our products incrementally cheaper. And what it also does is a weaker dollar deters U.S. imports. If those two things sound like what the goal of the administration is, it certainly should. Because both of those things very much so would say, let's hone in on making the things here. If you have to export them to other nations and we'll balance out trade deficits that way. But whether it's accidental or not, this weakening of the currency does kind of play into the general theme of what's trying to be achieved under these trade deals. So I thought that was kind of an interesting thing. Now, could there be some gamesmanship behind the scenes? Could the U.S. perhaps be trying to weaken its currency and actively maybe even trading it? That might be a little conspiratorial, but certainly these are big moves over the last 6 months we've seen in the U.S. dollar to the weakening side.
In your opinion, does that attract or deter companies from moving production back home?
You're helping out my transition exactly, which I would say perhaps not coincidental. Just in the last week, maybe 2 weeks, we got news that GE Appliances, General Electric, obviously not a small name, they are looking to move a portion of their Chinese washing machine business from China to Louisville, and along with that, a $490 million investment and 800 full-time jobs. So not immaterial. And again, we're not trying to prop up the administration as doing all the right things, but these are certainly little anecdotes. Maybe not even that little. These are somewhat substantive aspects of what a weaker currency, what a tighter trade policy can have, and it really does look like some companies are actually putting boots on the ground and taking action to kind of support that narrative.
Yeah, there's been a few of these announcements. I mean, GE Appliances obviously being one of the bigger, but
there have.
Yeah.
Yeah, I know we mentioned one in Cup of Joe last month. I think Generac Power Systems, which is out of Wisconsin, they've been very vocal in saying that any of their manufacturing or any place where they can domesticate their supply chains, they're working to do so. So again, these are just handfuls of instances, but I think it is happening behind the scenes quite a bit.
Yeah, definite progress.
So hopping over to the commodity side of things, I'll start out on steel, go to aluminum, a little bit on stainless, and then we'll finish off with copper. First, as we often do, looking at U.S. steel prices relative to foreign markets. The U.S. market's currently trading right around $900, plus or minus about $10, and it's really whatever index you look at. Whether it's here, we're looking at the front month futures contract. If you were looking at CRU, which is trading at 901, Fast Markets is trading right around 910. All of these indices are kind of converging right around that $900 level. And they're kind of doing so in a very calm and orderly fashion. And why I say that is, even though we've had pretty massive announcements with tariffs, the 50% tariffs on both steel and aluminum, the move up to where we are and then the kind of comfortability of prices being right around these levels is very, it's interestingly calm. We're not seeing the knee-jerk reactions the way we did back in 2021 or 2023 when we had the breakout of Russia, Ukraine. But we just kind of moved a bit higher, $100, $150, and we're just kind of stuck here. And if we were to look at futures, I don't have a chart of futures, but if we were to use futures as a proxy for where the market thinks we're going to go, basically futures are kind of trending right around, let's call it 835 up to 900 for the balance of the year. So, call it like a $50 to $70 range for the back half of the year. So the market's kind of saying we might see a little bit of downward moves, but as long as we have 50% tariffs, it's looking like the floor has been lifted. The other thing that's going to help to lift the floor is going to be shown here on this chart, which is we are actually seeing import levels decline. And it may not look like a whole lot, but the June figures were tracking at about 1.6 million tons of steel, and that includes stainless steel coming into the United States. That is probably about $600,000 or $700,000 per month below the 5-year average. If you annualize that, you're talking 7 million tons of steel. That's material. This is a suggestion that the tariff talks, the ramp up of 50% tariffs is actually having an effect on tightening foreign metal from coming to the United States. So I think that too is going to add somewhat of an incremental floor in steel prices.
Wow, that's the lowest it's been in this entire chart going back to October 2021. That's big.
That's right. I was trying to take it all the way back, but it starts to mess up the chart a little bit. But it's basically the lowest levels since late 2020, I believe it was. So it's been a while since we've seen these types of import levels. And even back then, I think you have to throw an asterisk on it because that would have been around the times when we had COVID lockdowns and people didn't know when businesses were going to reopen. So it's certainly a material move to the downside on imports.
And the HRC is at 883, or the CRU, I should say, for hot rolled, right? But isn't the Nucor came out, 910 this week?
Yeah, Nucor right? CSP is currently sitting at 910. But like I said, all of the indices, regardless of which one you look at, they're all within about a $20 range. They're all pretty darn tight right now. So there is some convergence in thinking of where everybody thinks the fair market value should be in the present time.
Yeah.
Okay. I guess, Mike, do you want to give a quick background on the steel side of things, on how we went out to the market?
Absolutely, yeah. So we, just like we did last month, we on the Tuesday prior to Cup of Joe, we're engaging our LinkedIn audience about, hey, what do you want to hear a little bit more about? And we had a few options this week, and overwhelmingly, over 50% of the respondents said that they want to hear a little bit more about carbon plate. And I'll get into this a little bit. So. Of course, Nick's got some stuff keyed up here, but Brian Crane, who's one of our product managers, deals a lot with carbon plate. We asked Brian, hey, can you give us a few thoughts on this? And he really pointed out things like he says large pipe jobs, above ground storage tanks, oil and gas, shipbuilding. Those have what really been hot, right, for the past 4 or 5 months around the plate market. But order books still are not full, and he's thinking heavy equipment and ag products really haven't had great demand. So Those are the markets, he says, that's really kind of driving the plate. And it's a lot of, in terms, in general, it's a lot of the uncertainty around things like tariff, right? I mean, that's what, everybody's dealing with. But I think that his high note was, prices for plate ran up in March, and they were fueled by tariffs and strong orders. But then it's kind of settled, and pricing has stayed relatively level. Nucor kept their published plate prices for 3 months, and Nucor raised its prices, totaling about 300, he said. So
yeah.
Those are his notes. Again, Brian Crane pretty tapped into that market, but what do you got for us on the
I mean, it sounds like the end markets are actually pretty decent, with the exception of maybe large equipment and as you mentioned, the agricultural side of things. But other end markets actually look pretty decent. It sounds like there's some small holes in order books, so the mills aren't running on the plate side at 100% capacity. But it sounds like it's incrementally better than what we're seeing on the sheet side of things. But that being said, you can see pretty dramatic move up in, let's say, the February-March timeframe. And then it's basically kind of created like a flag pattern, sort of plateaued out right around the $1,100 mark. Not too dissimilar from what we've seen in carbon flat roll as well, where we saw about a $150, $200 move higher. And then we've kind of comfortably been sitting around these levels. So I would say the resumption of some sort of correlation between hot roll and plate seems to be back to a degree. If you look back at this chart over 5 years, the white line is going to be your plate pricing. The blue line is hot roll coil steel pricing. And the sheet markets just tended to be way more volatile, where it was roller coaster down, elevator up, roller coaster back down. Meanwhile, the plate market just kind of drifted. It drifted up and then it drifted down, but it was on a very large, momentous scale, whereas the moves were much more swift within the sheet side of things. So it looks like the relationship between sheet and plate is starting to come back. Let's call it about $200-$300 is sort of that spread, which, if you remember back in 2022, we were seeing that spread upwards of like $1,000, where plate pricing was at that large of a premium. The only incremental thing I would say on the plate side that's a small positive for the short term is, as I understand it, within the One Big Beautiful Bill, there's a section that's kind of saying if a clean energy project is underway within the next 12 months, it's still going to get some subsidies and some government funding. I think that number in the previous bill, which was getting turned down, I believe the time frame was only 90 days. So basically, they've extended the runway for clean energy projects, which would include things like wind energy, consumes a lot of plate. That space should get a little bit of a reprieve, given the fact that that window is now 1 full year. So after that, there might be some question marks, but at least for the next year, it's looking like some of those clean energy projects will continue to get some subsidies.
Did you read the whole 1,200-page bill?
Never. I can't read that well.
One other note that from Brian, I don't know if how big of a significance this is, but Brian mentions it that it is. So he said that private equity firm Atlas Holdings is planning to acquire, I'm going to butcher this name, I apologize, Evraz, North America?
Evraz, yep.
Evraz, nailed it. All right. They're a plate mill in Portland, so they have long products too, but I'm sure you're going to be talking about some mergers and acquisitions coming up here, but I think that's another one maybe in the market that could have some impact on the plate market.
Yeah, for sure.
Yeah.
And as with any private equity deal, you'd probably expect a lot of rationing to take place, perhaps some jobs being cut, things like that, just to make it run more efficiently, as private equity tends to do. But yeah, I don't have a whole lot of extra commentary to add there. Mm-hmm. But you mentioned mergers. I do have a bit of commentary to add. It is now official. We do have U.S. Steel, which has been acquired by, and it's funny, the way everybody in the administration is talking about it, it's a partnership. It's something. Let's not beat around the bush. This is an acquisition of U.S. Steel from Nippon Steel. So they are going to be wholly owned by a Japanese firm, but they are going to maintain their name. There are a few other caveats that I think are worth pointing out, because I didn't know a ton about this as we were leading up to the acquisition going through. But there's this clause called the golden share, and apparently Trump was the one who wanted to really take control of this. But within, and I'm not going to read everything that's on the screen. If you're watching and you have the imagery up in front of you, you can certainly give this some time to read through it. But ultimately, it does have this golden share clause does have some seemingly interesting power to control some of the decision making of what happens within U.S. Steel. Specifically, it's things like being able to appoint a board member. So being able to appoint one of the 3 independent board members, basically Trump or whoever the acting president is at that time has the ability to assist in that decision or veto any other decisions that take place. It also gives the administration pretty heavy veto power on things like changing the company's name, where they source certain things from, some business strategies, which is kind of a curious thing that the administration would get that heavily involved in a company's operations like that. Obviously, there's very heavy union involvement within U.S. Steel, so there are obvious linkages between the administration and with these steel workers. But the direct notion to say, I want to have the ability to make these final decisions or veto these decisions around your strategy or where you're sourcing your raw ingredients or who you might acquire down the line. It's I probably need to be careful about how I say this, but it is pseudo nationalistic, almost like something that a China would do, where you have kind of a state-run enterprise. I'm not going to go fully to say it's that, but it at least reads that way a little bit, where the administration does have some say in how this organization, this new U.S. Steel being run under Nippon Steel, how it's going to operate. So kind of fascinating there. I thought that was somewhat interesting.
The points that stand out to me is, right, they can't close or idle these plants. They can't transfer outside the United States. And then the one that kind of stands out to me, and maybe it's nothing, but it can't acquire competing U.S. businesses. So you really can't further consolidate the market there, right? So
yeah, for sure.
Kind of keeping more businesses at play. It's interesting for sure. Yeah,
it is interesting. I mean, my personal take, I think the acquisition from Nippon Steel, at the very least, the investment they're going to make, it should be beneficial for steel operations within the United States overall. Should help operations be run more efficiently, hopefully more technologically oriented, and I see those things generally as good things. So,
Agree.
Yeah, pretty big numbers we're talking. It's like above $10 billion they're planning to invest over the next 3 years. So, I guess I'll leave that there.
Yeah.
Switching over to aluminum, where we continue to see some fireworks. I've here on the chart, I've got a 5-year chart of Midwest aluminum. So that's going to be the London Metal Exchange price plus the Midwest premiums. That's going to be shown in the white line. And then the London Metal Exchange price is going to be shown in blue. So that's just the LME ingot. So where we're really seeing the bulk of the moves, as you can see, is really within the Midwest price, which is going to be inclusive of premiums. As I think we mentioned a month ago, those premiums are fully going to be respective of whatever the tariff rate is on foreign providers of aluminum, most specifically on Canada, because they are the largest exporter of aluminum ingot into the United States. And with pretty much every country right now having 50%, there is a suggestion that we could see premiums go as high as like 70, 75 cents. And I've got a chart detailing that in a bit. But as we look at this 5-year chart, Midwest aluminum, again, the white line shown here in this chart, we're starting to creep back into pretty rare air. And again, it's not coming by way of the London Metal Exchange price moving substantially higher. It's primarily due to the fact that premiums are going to record highs. As we sit here right now, the spot Midwest premium number is right around 65 cents. From what I understand, there are still inventories of aluminum ingot that are sitting around the country that were brought in pre-tariff that are kind of getting discounted out into the market. The expectation is there's maybe a month or two more of those units still out there that could be holding the Midwest premium price down a little bit. But nonetheless, these are pretty swift moves. Obviously, if you're a consumer of aluminum, you want to be aware of this because we have seen pretty rapid rises, and ultimately, these are going to be seen out in the market very, very soon. And this is irrespective of the fact that we have also seen conversion prices go up from the domestic mills to the tune of 10 to 20 cents, depending on the product. When we look at futures, though, for Midwest premiums, as I mentioned, the spot current number for Midwest premiums is right around 65 cents. As we look at the futures curve, you see something very, very different. It's a very downward sloping, what we would call backwardated futures market. And as we go out to like 2026 months, the number is already about 15 cents lower than where the current spot number is. So why would that be happening? Well, I'm just going to dive into a little bit of math real quick. And this is sort of a busy chart. I know we talked about it last month, but I just want to reiterate this notion that the Midwest premium market is going to be one that's pretty binary. And what I mean by that is there's going to be a lot of emphasis within the aluminum trading world on watching what happens with USMCA talks. And I would say most specifically in aluminum, it's going to be on Canada, because if we assume the current LME price is around $1.13 and everyone currently has 50% tariffs, the impact over here in this blue section, the expected impact is that premiums should go up versus pre-tariff time period, so versus like 2024 time frame when premiums were about 20 cents. The expected increase to those premiums should be around 53 cents. So that would put kind of the fair value of bringing imported metal into the United States at around 73 cents. So it's a big number. Again, that would be a record high price for Midwest premiums. But the math kind of suggests that would make a lot of sense. So why are futures pointing downward? Well, there are some in the market, and perhaps I would say I'm somewhat included in this, that think that there could be some exclusions, some exemptions on certain nations. Now, I don't know which ones those are going to be. I don't know what that looks like. I don't even know if it's going to happen. But if it were to happen, and let's say Canada gets an exemption on all of their tariffs for aluminum. So we take that tariff rate down here in this bottom section to 0%. And just for kicks, let's take Mexico also down to 0%. Just those two nations alone changes the increase impact from 53 cents to 10 cents, which on an all-in basis would put the implied premium back down at 30 cents. So this is where, as a trader, a risk manager, or even a consumer of metal, it's a very difficult landscape to navigate in, because just with the stroke of a pen, you could see premiums go up another 15 cents, or you could see premiums drop by 30 or 40 cents in a very quick fashion. And there's no real way to really handicap that risk. But I think we at least have to note that those things are on the table. We could see another 10 or 15% increase in prices. We could also see a 20 or 30% decrease in prices in pretty swift action. So, we want to keep a very close eye on how these discussions are going, particularly with USMCA nations, to gauge what that likelihood, what that probability may look like, and then try and gauge where premiums and aluminum ingot prices are going to go.
What is the latest with Canada? I know it's funny, like you and I will shoot messages to each other, on occasion, and every time you send over something, it's like there was one. It was like we were close with. I think it was last Cup of Joe, right? We were very close. It seemed like we were very close, and then it just kind of goes away.
It's interesting because how those trade talks are going. There's almost a direct correlation to where Midwest premium prices go, and it's almost like within the day. And what I mean by that is last Friday, Canada announced that they were going to impose, and I don't have the exact specifics, but it was something along the lines of like a technology tax, that there were going to be certain technological things that were going to get taxes on it. And I believe it was going to hit a lot of the hyperscaler companies here in the United States. So think like Meta, Google, Facebook, all those companies. Meta is Facebook, but you get the point. Yep. Mm-hmm. By them announcing that, and almost single-handedly by them announcing that, pretty quickly, Trump went to Truth Social and said, "We're walking away from Canada. These talks are not going well. This is nonsense." And so that it was kind of, they were scrapped. And as soon as that happened, Midwest premiums the next day shot up like 10 cents. And so I think it was on the back that the probability of something getting resolved was looking worse, which meant we were going to wind up more in that top case scenario of higher premiums. Lo and behold, we come back in on Monday, and all of a sudden trade talks are back on, and things are looking a whole lot better. And Canada says they're looking at putting their own restrictions on steel imports into their country, and all of a sudden it's a little bit back on better footing. So it's going to be a fluid situation. It's going to probably come in fits and starts, but I think my gut still says that there's going to be a goal of some sort of resolution that they can celebrate at some point. I don't know whether that's going to be in 3 days or whether it's going to be in 3 months.
Yeah, has to.
Yeah. switching over to nickel and stainless prices. Nickel, I'm going to breeze right through this one because it's really much of the same story that we've been seeing in the last several months, which is it still remains a market in surplus. Indonesia continues to oversupply a bit, but we are really grinding along the cost curve of where nickel miners can make money extracting metal out of the ground. So we continue to trade sort of either side of $7 a pound. Nothing too crazy on the commodity side of things, but where we are seeing some pretty dramatic things to look out for and be aware of is really all of the domestic mills on the base pricing side have increased prices. So it doesn't really have anything to do with commodities. It far more so has to do with the fact that there are tariffs that are now implemented. So this particular listing of price increases is coming from North American Stainless, but and I didn't want to detail all of them, but ATI has very similar looking increases. And now more recently, Outokumpu has also come out with a wave of base price increases. So I'm not going to get into the details of all of these. There's a lot of reading, obviously, and it depends on the market and the supplier. But these are not immaterial moves in the base pricing. And from my personal standpoint, I don't think the market itself warranted these types of price increases. Like, I don't think the demand was really driving this. I don't think the market was tight per se. But I do think that solely the tariff risk is really blocking off, it has the potential to block off a lot of foreign supply. And by blocking off foreign supply, or said a different way, by making foreign supply more expensive by way of putting tariffs in place, that does give the domestic players a little bit of a moat to increase prices, whether we like it or not. That's the landscape we're in. So I'm going to leave it. I'm going to leave it right there. But it is worth noting. We probably are going to see in the coming months, both for Ryerson and for our customers, we are going to see some price increases. They'll be somewhat substantial depending on the product.
Yep.
And as I always say, last but not least, but on the copper side of things, again, we are back to knocking on the door of all-time highs, particularly for U.S. copper prices. So that's going to be COMEX copper shown in the white line. The reason why you see this gap, which has really been developed over the course of 2025, the gap between COMEX prices and which really is the U.S. price, and the global or London Metal Exchange price is again tariffs. There is an expectation among many analysts that perhaps as soon as the end of July, we could see announcements of copper tariffs being put in place. We don't know exactly what that rate's going to look like, but right now the market's sort of handicapping that percentage right around 10%. And I say 10% because you look at the London Metal Exchange price at 450, toss 10% on top of that, that gets you roughly about where the COMEX price is. But again, this is a market that's been tight, continues to look tight, and maybe even looks like a little bit of a squeeze on pricing as we sit here right now. Because again, we've only really tested these types of price levels 2 other times, and we're getting right back into that territory. So, if you're a consumer of copper, certainly want to keep a close eye on those announcements with regards to tariffs. If there are not any tariff announcements in the next couple weeks, I'd say you'll probably start to see that premium creep back down, and maybe COMEX prices get a little lower towards the global price. But there is a risk premium there for now that I think we have to keep an eye on.
I should note, as always, if you have a question, there's our Q&A button down there at the bottom. We got one about news, and I believe you and I discussed this, not on the show, but a little bit ago, about a U.S. and Mexico and an possible import quota in trade talks. Is there any news on that front?
Yeah, there has been some discussion around tariff rate quotas with Mexico. I haven't seen anything official announced, nothing in writing just yet. But the rumor is that they are discussing some sort of tariff rate quota, likely based on some historical level. So I don't know what that time frame is going to be, but it could look something like take the last trailing 5 years, or maybe take 2018 levels, and up to that volume that was imported in the United States based on some years levels. They'll say, okay, no tariff on that product, but anything above and beyond that is going to get 50%. That's probably what it's going to, or that feels like what it's going to look like at the moment. And I think there is probably some validity to those rumors, but that's really what we know thus far.
And hopefully, as I alluded to in the beginning of the show, that we'll be talking with some folks from Ryerson and in our Mexico office facilities. Right. So hopefully, have something to talk about next month.
And if I had to make a prediction, we'll see how it plays out, but I'll just throw my prediction out there just because I like to I like to be wrong sometimes. But if I had to guess that, this whole theme of, again, targeting China ultimately being the real culprit, it wouldn't shock me if a tariff rate quota comes into effect with the caveat that Mexico itself is going to block some foreign metal from coming into their own country. Because again, this whole idea of transshipping is really what the USMCA is trying to avoid. That's at least my opinion. So I think if something like a tariff rate quota is to go into effect, I think it'll probably have with it something that says we're going to make an effort to put our own tariffs on foreign product or our own quotas on other product, is my guess.
You don't like to make predictions. You like to throw yourself softballs. So at the end of the year, you go to your five things and say that's a prediction that came true.
That's right. It is sunny outside right now. That's my prediction.
Yep, nailed it.
Speaking of predictions, let's top over to the macro side of things before we have a little bit of fun and wrap this up. First things first, we have seen a small bit of positivity within the S&P Global PMIs. I would first highlight the top right section, which is showing that we now have a global manufacturing PMI just slightly above 50. So that's slight year-over-year growth. It's not going gangbusters, but it's slightly back in positivity after we've seen two degrading figures. We are seeing strength here within the United States on the S&P survey. And I'm saying it that way for a reason. The S&P global numbers do look a little more optimistic than the ISM, which is the Institute of Supply Management numbers. Unfortunately for our friends on the North and South, both Canada and Mexico have had about 4 or 5 months of somewhat troubled times. I think these trade talks are not boding well for either nation right now. My guess is that both of them are probably eager to get something done with the administration. It's just not happening overnight. So unfortunately, both Canada and Mexico have seen a little bit of what looks like pseudo-recessionary type numbers, maybe akin to what we had seen in the Eurozone for the last year or so. And with that said, the Eurozone is starting to creep a little bit out of that recessionary territory. So we're starting to see the Eurozone numbers getting closer and closer to that 50 level. It's still not growth, but it's marginally improving in terms of the weakness. And then even down on the bottom right-hand corner, which is emerging markets, I wanted to highlight, we are seeing a small bit of strength within emerging markets. So smaller economies are seeing some strength there. And then, last but not least, we always talk about this, but India just continues to chug along. 58.4. It's just straight green across the entire banner. Just wild stuff. But marginally, we're seeing a small bit of improvement. I think some of these talks around trade and the idea that there is a little bit of movement forward. I think the Vietnam news yesterday is going to be, again, a pseudo blueprint for what other nations can do. I think those are going to help to soften things up and provide at least maybe not a tailwind, but at least the removal of the headwind for markets.
What kind of countries fall into emerging markets, for example?
Yeah, emerging markets would be any. I don't want to use the phrase like second world countries, but it would be any economies that just are smaller and trying to grow faster.
Growing faster. Okay. Yeah.
So yeah, I mean, call it Indonesia, like East Asia nations. If funny enough, I believe even China is still categorized within the emerging market side of things for now. But yeah, it would be kind of most of the other nations outside of the Eurozone and North America.
Would Vietnam fall in there?
Vietnam would fall within emerging markets.
Okay. That makes sense. Okay.
So this is what I was noting. There's a lot going on here in this table, but over on the top left corner, that is ultimately looking at the S&P Global manufacturing PMI. That's going to be shown in the orange line. And then the ISM is the Institute of Supply Management survey, which should be attempting to survey the same things, is down at 49. It has ticked up a little bit, so that's good news. But you can see there is about a 3 to 4% difference between the two indexes. One is actually suggesting there's weakness in the market. One is suggesting there's moderate growth in the market, or rather optimism, because these are surveys. The only thing I'll really highlight on that is, from what I understand, the Institute of Supply Management tends to focus on larger companies, perhaps multinational companies that have dedicated purchasing managers, and those are the people that they survey. The S&P Global Index tends to have a little heavier weighting on small and medium enterprises. and also takes into account certain other executives within the companies that are not purchasing managers. So, one of the ways I would explain that would be small, medium-sized companies probably don't have as many issues to deal with as it relates to tariffs. So they probably are seeing things a little more optimistically than, say, a multinational company that has to reroute supply chains or pay up on tariffs, things like that. So again, these are surveys, so they can be fudged by people just, falsifying data. But that's kind of my read on why we've seen this spread between the two indexes widen out a little bit, because one's actually slightly positive, the other one's moving in the right direction, but actually in negative territory.
And I correct me if I'm wrong, but the ISM is a survey of almost like feeling, like how does the market feel, right? Or how did where?
Yeah, and technically both of them are. Both of them
okay.
are saying how are you feeling about general conditions in manufacturing right now?
Yeah.
The ISM, the benefit of the ISM is it tends to be a little more granular in terms of how are things looking from a pricing standpoint, how are inventory levels. They do a better job of breaking all that out. But ultimately, the headline numbers should be attempting to achieve the same thing, which is how you feeling about the economy.
Yeah, good.
Another place where we're seeing some divergences is within the jobs data. And this has all come in the last 24 to 48 hours. You can see that over a longer period of time, we're looking here at the ADP, which ADP is a private institution that tracks the employment of people within their systems. And then the other, so that's going to be shown in the blue line. And then the other line is going to be the non-farm payrolls figure, which is coming from, it's a governmental figure. So it's more of a public data point. And you can see that generally they do trend over time with one another. And they have both been kind of trending towards a softer employment picture where it's still for the most part, still in growth territory in terms of adding jobs. But here in the last data point, we got a pretty severe divergence where the ADP, which again, ADP is tracking private companies, so not governmental hiring, tracking private institutions, and they just yesterday printed a negative figure, meaning no more job growth, actually job losses from the economy, which I think kind of spooked some people. And there were a lot of prognosticators in the market who were saying, it's time to cut. We're too late. I'm sure Trump was out pounding the table for Jay Powell to keep cutting it or to begin cutting interest rates. But then we wake up today and we got the unemployment rate, which had come down from 4.3 to 4.1, and we got the non-farm payrolls number in positive territory, which completely bucked the trend of what the ADP number is suggesting. So there is a decent divergence there, and maybe it's obvious, but one of the big reasons why there is a divergence is because the government, so public jobs, which is not tracked by ADP, it went up by like 75,000 jobs. So that did help to prop up the non-farm payrolls number. Now, I have to acknowledge the fact that, yes, government jobs are real jobs. They are real incomes, but it's got a little bit, that figure has a little bit of an asterisk on it because it is something that, the government ultimately can control. So that being said, I think more broadly, you take a step back, you look at this data, it very clearly looks as though jobs data is getting a little more squishy as we roll through time.
Okay.
As we peel back the onion on jobs a little bit more, the left-hand side is showing manufacturing jobs only. And so this is coming out of the non-farm payrolls data that we got this morning. And you can see that really for the better part of like 2 years, the job situation within manufacturing has not been stellar. And I would say that's been replicated within the ISM surveys, which similarly have not been all that stellar. So the manufacturing world still kind of is slogging along from a job standpoint. But again, I mentioned this on the last slide, but on the right-hand side, you can see it visually here. A big uptick within the jobs data from non-farm payroll standpoint was within the governmental move up. So again, a little bit of an asterisk there, but again, I think it does look like the jobs market is getting a little squishy, despite the fact that the unemployment rate did in fact come down. So before we get to the Fed and interest rates, and I'll breeze through this, but the inflation data actually looks fairly cooperative right now, despite the fact that we've had all this tariff rhetoric now for about 3 months. Even though we have not had any of them fully implemented yet, which could still be a risk. For now, all three, the CPI, which is shown in white, which is the consumer price index, the producer price index shown in blue, and the personal consumption expenditures, they're all pretty darn stable right now. So they are two out of the three are above the Fed's target of 2%. But the good news is they are pretty darn stable. We're not back in the times of 2022, 2023, where things were very elevated levels from an inflationary standpoint. But I don't think it's really yet time for the Fed to call victory, because those numbers are still a little elevated, and we haven't yet seen material weakness yet within the job space. So for now, there's a very, very low expectation. It's about 4% odds that we're going to see a cut in the month of July, later this month. There are decreasing odds that we're going to see a cut in September. But again, all of these things are going to be predicated around what happens with the jobs environment. If we are to believe that the ADP private numbers are a better reflection of what's truly going on in the market, then and if the Fed believes that to be the case, then I would say we're probably going to see cuts sooner. If we're using non-farm payrolls, which fortunately or unfortunately can be kind of adjusted with governmental hiring, then we may be kicking the can down the road another month or so. But it's still looking at, I think this is still the case last month. The expectation last month and this month is that we should get around 2 cuts this year. The only other thing I would say about the Fed and interest rates is it seems as though Jay Powell's job with the Federal Reserve is likely going to be ending within the next 12 months, and Trump and company are going to be looking for his replacement. And already in the last 30 days, we've begun to see some of the Fed presidents step forward and be a little bit more dovish in an attempt to maybe try and woo over the administration to try and get that job. My gut would say that whoever is selected or put up the next time around is probably going to be a little bit more dovish and open to cutting rates, just given the pushback that we've seen between Powell and Trump over the last several months. Again,
I thought we were gonna hear you're putting your hat in the ring for this.
I don't think I'm quite in that realm yet. Might need a few more years.
Okay, all right.
Well. Looking at the end market side of things, this actually kind of resonates somewhat well with what Brian Crane had talked about on the plate side. Yeah. Not a whole lot new to this story, but there's definitely a case of the haves and the have-nots within end markets. Non-defense aircraft shipments, as Russell Earls detailed last month, still going gangbusters. You're talking about 65% year-over-year growth. Wow. Absolutely staggering figures. Yeah, some of that may be off of pseudo-weak numbers in years past, but those are still very, very sizable numbers nonetheless. HVAC shipments, again, as it relates to data center build-outs, things like that, doing very, very well. Electrical equipment in a similar vein. And one that hasn't been up in this category for a while is ship and boat shipments, which is a little more of a discretionary spending item. That's actually perking up just a little bit. But as Brian had noted, things like construction markets, heavy equipment, mining, energy, farm machinery, those are all areas that are seeing a bit of incremental weakness. So not too much to note on this, except there is a continued notion that there really are the haves and the have-nots. Data center build-outs are going gangbusters, and anything related to the AI build-out is doing quite well.
Yeah. What was the number you brought out? You and I were talking maybe like a week ago. It was the majority of the number was it's not consumer spending, but the majority of it was for commercial airline, right? Where so much investment.
So that was going to be the actual durable goods headline number, which on a year-over-year basis printed up 16.5%. That's the headline number. If you pull out non-defense aircraft shipments, that number drops all the way down. It's still positive, but it drops all the way down to 0.5%. So that gives you an idea of the dollars being spent within the durable goods space on aircraft shipments relative to other things.
Yeah, Russell was right.
Yeah, for sure. Yeah. And sounds like he's going to be right for many years to come.
Time. Yeah.
So I've got a small little treat for everyone. Look
at that.
in the spirit of the holidays. Oh my goodness. I don't know what's going on with this thing. And I can't see myself in the mirror. So we're just going to have to go through this.
In the spirit, that looks great.
In the spirit of the holidays. I wanted to do a little bit of research on how much steel was consumed during the Revolutionary War. As you all probably know, steel was not a heavily produced thing here within the United States back in the late 1700s. But that being said, I got some interesting stuff from some artificial intelligence help. And we were able to make some educated guesses. And so within these educated guesses, for those who don't know, there were roughly around 100,000 individuals who were involved within the war. We'll call them soldiers. That was the word I was looking for.
Okay, I'm sorry. If we assume you got to pull it back. You got the founding fathers thing going, but you got like the Justin Bieber like hair in the face going. There we go.
I can't do it. So if we are to assume, it just keeps coming down. Yeah, I don't know what to do. But there's a little bit. There's a little bit in the back here too. But if we assume there are 100,000 soldiers, and we make some assumptions about how many of them had muskets, how many of them had swords or bayonets, it is estimated that only around 100 tons of steel was actually utilized within the Revolutionary War. That gives you an idea of how little and how actually expensive it was at the time. This, for what it's worth, this does not include things like wrought iron. So, things that are used to make cannons and cast iron, things like that. Those are not included in these figures, but tools and miscellaneous, that's going to include things like knives. And then the artillery components, I was interested, apparently there was a lot of steel that was in the wicks of the cannons themselves that had to be manufactured. Bayonets and swords, let's call it 25 to 50 tons. And then muskets, again, I think it was 0.3 pounds per musket, extrapolated over the 100,000 individuals. But again, it came down to a cost element. So a lot of that steel was actually imported from other places for the military efforts.
Not a lot of local production for steel.
Exactly. Yeah. Exactly. Perhaps not until Andrew Carnegie came along with U.S. Steel and really kind of revolutionized that process. But that wasn't for another at least 100 and so years.
Did you get with some Ryerson product managers for this data for when they were around the Revolutionary War?
Yeah, I think Ryerson was just getting off the ground around this time.
This is interesting. I've never seen steel consumption data about the Revolutionary War. Where else are you going to get that but Cup of Joe?
You can't get that anywhere else. I love it. That's right. Yep. And you're not just going to get Revolutionary War data. You're also going to get firework data. I wanted to dive into the metallics of fireworks. And so whether you're in Canada, whether you're in the United States, or whether you're Mexican and just happen to be in the United States enjoying some fireworks for these holidays, wanted to give you a little bit of a background of how metal matters, even for the fireworks that are blasting off in the air and helping us enjoy our holidays. It's interesting, about 50 to 70% of the firework is actually an oxidizer. It's really trying to allow for oxygen to allow for the combustion of the product. Another 15 to 30% is going to be things like either charcoal, sulfur, or our good friend aluminum, which are going to act as the fuel for the explosion. Perhaps one of the reasons why when you see them explode, or if you're nearby them, oftentimes fireworks give off that sulfury egg smell. If you like your colored fireworks, you need to look towards strontium, barium, and our friend copper, which we do some of, which are going to provide some of the coloring elements, about 5 to 15% of that product. You've got a binder. You have to bind it all together with the starchy product to make the ball. We've got polyvinyl chloride or chlorinated rubber for again, color enhancement. And then if you're big into the fireworks that kind of crackle or kind of glisten in the sky, that's going to most likely be something like a magnesium, a titanium, or an antimony that are going to provide some of those special effects, like what you're seeing over on the right-hand side. So yeah, next time you look up in the sky and you see a firework, just know metal matters.
I got some facts for you too. Did you know China's credited with inventing fireworks, but they didn't get colorful until Italy came into the picture. They were credited with making fireworks bright because they discovered metallic powders that create that desired colored effect. So
incredible.
Yeah, so China invented them, but Italy made them bright. That's what it comes down to. And I thought it was pretty interesting that 90% of the fireworks consumed here in the United States come from China. So wondering how many of those fireworks didn't quite make it to the United States this year.
I mean, it kind of makes you wonder if when Trump signs his one big beautiful bill, is he also going to put in place some sort of firework tariff so we can start manufacturing tariffs here in the United States?
Yeah. Fireworks here in the United States. Yes, exactly.
That's right.
Yeah.
By the way, I stopped sharing my screen, so for the first time in the last 10 minutes, I now can see myself, and this is just an abomination.
It's amazing. It's great. Yeah. I'm really jealous. You already have a great head of hair, and then you put on that thing. I think you're just kind of like mocking me, but
There is a backstory to buying this. This weekend, for those who care about my social plans, I actually have a Boston Tea Party themed party for the 4th of July.
Wonderful.
So I had to get my colonial gear ready. Apparently I need to get some hairspray in this one because it's just not, it's not doing the thing it's supposed to be doing.
Hair clip. I think hair clip.
Maybe. Yeah.
What are you going to be tossing overboard? Tea?
It most likely will not be tea, Mike.
Okay. Gotcha.
Yeah.
Okay.
And with that said, obviously for anybody who's still tuned in, we know that we are standing in the way of all of yourselves and your nice holiday beverages. So we really, really want to appreciate all of you for joining us around this holiday. If you're tuning in after 4th of July, I hope you had a great 4th of July.
Yes.
And we're probably going to figure out some way to edit out this entire segment on the back.
We're not. Nope. It's going to be the only portion of this episode we're going to show. No, but as Nick said, thank you for spending your holiday with us, and hope everyone has a safe and happy 4th, Canada Day. Hope it was a great celebration, and we will see you next month unless something big happens, and we'll jump on for an emergency cup of Joe. Thanks, everyone.
Love it. Thank you.